Hey, welcome to Hand Rolled Real Estate. I'm Robbie. I'm here with Jay today, and we're going to talk about how some of these current economic developments is going to impact the markets.
Hey everyone, I'm Junaid Noor. Thank you for joining us. Robbie, we're going to talk about economic impacts of the market, but we're going to focus on four areas which I think our listeners are most concerned about. We're going to talk about treasuries, we're going to talk about stocks, we're going to talk about bonds, and we're going to talk about real estate. And this is basically, we're not just telling you, hey, you should do this. We're telling you this is what we're going to be doing. These are the places we're going to be investing. And, people can, listen to it and follow it or not follow it. It's just for educational purposes for everyone else. But, we're looking at the future of our own investment portfolios. And we just want to give some people advice on what we're doing.
Yeah, exactly. This is just our opinion, and there are a lot of different opinions out there, and there's some good ones and bad ones, and you just have to figure out for yourself if you agree with our opinion or not.
So, the first thing is treasuries, right? So the big measure is the 10-year treasury. And I've always maintained that the bond market is smarter than the stock market. But interestingly enough, the 10-year treasury went up as soon as the Feds cut 50 basis points.
And that is really just not logical. I mean, it just from a borrower lender standpoint, it doesn't seem logical. But there's some in-depth reasoning behind these investors' decisions, and it's because they're in fear of a recession.
Right. And, the logically, the 10-year treasury should be tied to the federal borrowing interest rate. And if the Fed cuts its rates, the 10-year treasury should go down. But the 10-year treasury is tied more to the investor's perception of where the future will be. And the jump in the treasuries indicates that investors feel that the Fed cut too much, too fast. Just like when they increase rates too much, too fast. They cut too much, too fast because the Fed is fearing a recession.
Yeah, I'm hoping that's not the case, but I think we'll find out in November. They'll have another opportunity and a little more time to evaluate the impact of the rate cut. But hopefully, maybe things will stabilize. It seems like the inflation number looked good for September, and hopefully they just maybe give us another little bit of relief in November.
Yeah, well, as long as the unemployment numbers come in good, they come in strong, and inflation's going down, we'll have a great run. But if unemployment starts increasing, um, you know, uh, people are getting laid off, then you're going to have a recession because it'll be a trickle down effect, right? People get laid off, they stop spending or they cut down on their spending, and then the affected businesses whom they are not spending from or they're not purchasing from will in turn start laying people off. So you're gonna start getting into this recessionary period, and then the Fed's gonna have to cut much faster.
Yeah, and if you look at uh, the stocks, uh, for example, I mean they reacted more in line with what you would expect with a rate cut.
Right, and the reason being is that with stocks, a lot of borrowing it happens. The corporations borrow a lot of money, um, and because the interest rates are cut, their debt service will go down, which means income will go up, and the stocks will start doing better. But tell me what you like. What kind of are you S&P 500? Are you individual stocks? What do you go after?
For me personally, I have a pretty good mixture. I like the S&P 500. I like some of the big consistent winners, and then I do like to seek out some smaller individual things that maybe just have my interest, where I can do some due diligence and some homework, and maybe get a little bit bigger return.
So speaking of smaller companies, the Russell 2000 index historically does much better when rates are cut. And the reason being is because the Russell 2000 companies are smaller to mid-sized companies, and they borrow using the Fed overnight rate more than long-term bonds or anything like that. And so they get affected dramatically, their debt service goes down, their income goes up, and so usually those companies and if for someone like me, I don't have a lot of time to go research companies out, so I usually stick with the indices: S&P 500, Russell 2000, the Dow Jones, diamond ETFs. And we're not endorsing anything. I'm just saying this is what I buy, so you buy what you need to buy. But anyway, the Russell 2000 index historically has done better when rates are cut.
Well, we've touched on the treasuries and we've touched on stocks, and maybe we could talk a little bit about bonds. It seems like the bonds tend to mirror the treasuries.
Well, yeah, and it's the same reason, right? And we'll touch on this a little bit because I'm not a big bond investor, and I don't know if a lot of people out there know how to switch between stocks and bonds or how to put a portfolio together. And we're mainly real estate investors and some stock, but bonds is the same reason, right? Investors think a recession is coming. Therefore, there will be more bankruptcies. Therefore, any money that they lend for corporate bonds, they require a higher premium. And you can see that, right? The bond market, the treasuries have gone up, all the bond premiums will go up as well. The yields are going to be higher because, the investors are fearing recession.
Well, I guess we can jump into to our favorite topic, real estate. The rate cut definitely has gotten the real estate market a little bit more excited. I think it's going to open some doors and create some opportunities and hopefully get some money into the hands of some of these developers.
Yeah, a lot of people think that just because the rates got cut, 30-year. So let's talk about residential, and then we'll talk about commercial, right? So the residential has to do with a 30-year fixed rate, and the 30-year fixed rate already dropped previously before the rate cuts in anticipation of the rate cuts. I think it's down to around 6.5. It doesn't seem like it's going to drop anymore because the rate cuts were already taken into account. So 6.5 is not a bad mortgage. It's not 3, but I don't think we'll see 3 anytime soon. But 6.5 is not a bad mortgage, but the big problem is supply. And that's where we get into the commercial aspect of real estate.
Yeah, and in regards to the residential mortgages, I mean, and one of the things obviously is to get the interest rate down, but one of the biggest challenges that they have is the supply and getting that supply in line, and getting capital more easily available to these developers and home builders. Hopefully that will allow them to kick off some developments and hopefully start getting that supply a little bit more in control, which in turn will drop the price of the current supply.
Yeah, absolutely, Robbie. The new housing starts. We're hoping that the new housing starts will increase because borrowing costs are lower. Developers will start getting into more development projects, which will help the supply problem. Because even if the interest rates were down at 3% right now, you have two sets of supply, right? You have existing home supply, which is somebody wants to sell their existing home to upgrade into a nicer, bigger home, or they want to downsize, right? They're an empty nest and they want to downsize. On the existing home supply, in order for them to move into a brand new shiny home, there has to be a brand new shiny home available that someone is selling, right? So the existing home supply is not going to start increasing until the new starts start developing and start making more homes, because there's nowhere for somebody to move into if they want a bigger home or a newer home. Now, same thing with downsizing, right? One of the reasons that home prices are so high, even in a city like Houston, where historically they've never been so high, is because there's no new supply coming on the market and there's no existing supply. People who were, leaving a 3% mortgage did not want to go into an 8 or 9% mortgage. So they're just going to wait. And they have nowhere to go. There's nothing new that's on the market. So, with the decrease in interest rates, hopefully it'll start stimulating the economy so that people will start moving. That means giving up, selling their existing homes where other people can move into the existing homes, which are usually lower price because they're older homes. And with the lower mortgage, the payments will be low enough that they're affordable.
Right, and there's been such a increase in just overall value of homes, and uh, particularly here in Texas, but I think it's occurring across the nation, and it's a supply problem, and there's only one way to get around it, and that's to build more homes and have more available units.
Yeah, and going to or switching to commercial on the multifamily side, which is one of our favorite subjects. The we have been exploring the development of a multifamily project for the last 3 years, but the interest rates were so high that it would just not pencil in, and everybody else is in the same boat. So we with the interest rates dropping now, there will be more supply coming onto the market. And again, right, it's regional. So Austin is a little bit overbuilt, but that supply is going to be. I think the last thing I read was that in 2 years, Austin is going to be back on supply and demand will meet. Right, so they're going to need more supply coming onto the market.
Yeah, and adding to that, there's just been very few multifamily transactions over the last couple of years. It's really slowed down. It's the only time you're seeing anything come up for sale is if they're in a crunch or if they have to sell. If they're in financial troubles. Another thing that really took a beating was all of the land purchases. I mean, we've been trying to acquire some properties, and it's just it was a challenge just to even find lenders on raw land deals because they were terrified of any of those land deals.
And to your point, Robbie, it's really the lenders, right? Banks are conservative by nature, and when they fear, uh, you know, inflation in the sense that, or when they fear that the Fed is going to keep raising rates due to inflation, they really just kind of hold back on lending, and they won't take the risks which they would normally take if the interest rates are a little bit lower, because their borrowing costs go up too. Um, Now we saw a lot of distress coming out into the market, and I think there's still going to be more distress in the market. Now remember, there's two types of distress, right? There's management distress and debt distress. I think we're still going to see a lot of management distress properties. We may not see as much debt distress properties, but what happens is when distress happens, the bank it kind of opens the eyes and opens the books for the bank, and the bank says, you weren't that great of an operator. We're not going to refinance you even with a lower interest rate. And that forces the person to sell the property because at the end of the day, bankers don't want land and they don't want multifamily units. They just want interest, right? They want their payments, their monthly payments, and they want their loans paid down. They're not in the business of running operations. They're in the business of lending money.
Yeah, they don't want to be multifamily property managers. They don't want to own commercial properties, lease properties. They would just, you're right. They just want to lend money and make their money on the interest, and let the developers and let the property management teams and let those guys do their job. And in a perfect world, they prefer not to get involved. And I think a lot of the banks probably did a better job than historically with renegotiating some current deals. I heard some pretty creative ways that these banks got some of these loans restructured to keep these businesses thriving.
And I think the banks are in the same position with commercial properties now that they were in with residential properties in 2008. Their eyes are kind of opening to the fact that a lot of these purchasers or these operators bought very highly leveraged properties with a lot of very aggressive computations and aggressive assumptions, thinking that rents are going to keep going up by 10, 12, 13, 14% every year. And now the banks are kind of looking at it saying, your assumptions were all wrong. Rents went up. Yeah, they went up 13, 14% during COVID, but now they're only going up the normal 2 to 3%. And, you guys, your underwriting was really off, and therefore we're going to be a little bit more conservative and try and sell the property off. So we'll still see some distress in multifamily properties. It'll be management distress, not as much as debt distress. But interesting tidbit of information: when the stock market crashed in 1929, it wasn't all because of the stock market itself. The crash was mainly because there was a lack of liquidity in the market. So when the stocks crashed, banks and other lenders stopped lending. When they stopped lending, a lot of the people who borrow money, especially overnight money, couldn't afford to make payroll. They couldn't afford to buy inventories. They couldn't afford to collect. They couldn't collect on their receivables, and then you had this click, 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 click trickle down effect. And this is the reason that Ben Bernanke used, because he was his thesis was on the 1929 crash. He used this in 2008 as the reason to do quantitative easing and for the Fed to print more money and push more money into the economy.
I think that concludes, our podcast for today. But I was going to mention that our next podcast is going to be on should you invest in in rental properties in 2025.
I mean, I think that's going to be a great topic because a lot of people are wondering, well, rates are cut now. Should I go out and start buying my investment properties, my single family home, and I can become a millionaire? And we'll talk about the pros and cons, and we'll tell you what we think people should be doing in 2025, since we're going to be doing something similar in 2025, right? We're trying to put our portfolio together and our strategic plan together for 2025, and we'll share that with other people.
If you have anything you'd like us to actually mention or talk about or discuss on our next podcast in regards to should you invest in rental properties, hit us up on our website or social media. We'd be sure to include it. Thanks for joining us today, and hope to see you next time.
Have a good day.